Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to wealth building, commodities, and/or financial topics. So let's get in there. Let's see what's going on with the markets and what is being shared in social media. If you want to follow me, at Finance. If you want to join our community where I dive deeper into individual companies, individual sectors, if you want to go back and forth with myself on Discord, you can sign up. We have a coupon code MAYDAY, MAYDAY, one word. And you can see what I'm buying and how I'm positioning for this commodity bull market that is not only coming up, but we're in it. We are in it. So coming on down to David Orr, another thought on Kelly. I kept stewing on because maybe it's wrong, but it just seems right. So full Kelly, they're talking about a full position. Full Kelly only pays a bit more than a half position or half Kelly. Not risk adjusted, but in absolute terms. Assuming a portfolio uses up all of its capital, the one with twice as many half Kelly bets will have a way higher return, assuming the edges are equal. Even if the edges on some bets are a bit lower, the expected value at the portfolio level is still higher. I bet there's some really elegant math proof, maybe which hasn't been proven yet, that shows the connection between this and more diversification pushing up geometric returns. So just to kind of go over this, guys, he's talking about the positions of a half position versus a full position. And really what they're talking about is if you put a full, quote, a full position on a full Kelly, you would hold less positions than having a bunch of, quote, half Kellys. It's what they're calling it. And what they have found is when you put a bunch more bets on, kind of spread it out a little bit more, the symmetry, the likelihood of some of those stocks capturing the asymmetric opportunity to the upside gives you higher returns than trying to kind of guess which stock may give you the best return and putting a much larger position on an individual stock than dividing it up amongst two or three or four. It's almost like playing statistics is really what it is. And that's, some people look at my portfolio, they're like, why do you own so many uranium stocks? And they're not very huge positions. This is the exact reason. It's the symmetry that's going to catch me higher, and I don't need a ton of money in it. I just need money in it. So it's not about me guessing which uranium stock is going to give me a 20, 30, 40 bagger. It's more about capturing the return of a 20, 30, 40 bagger out of 10 possibilities that I think are there for that to occur. So rather than putting all my money and guessing in one company that may or may not work out in the end, I'll take the bet across 5, 6, 7, 8 of my favorite companies that possess what I think is going to have the largest returns. That's not like buying an ETF, though. An ETF, an exchange-traded fund, most of the time, they do not perform as good as what I just described. They have way lower returns because they have a bunch of stuff in that ETF that weighs the ETF down. They usually overweight some large company or 3 or 4 large companies that I don't want exposure to. And I want exposure to, let's just say, these 7 companies in this particular sector that can go crazy. And then I've got 7 different sectors, 3 to 7 holdings in each. You might have 50, 60, 70, 80, 90 companies, depending on what sector you're in and if it's a really high risk bet. High risk being, an explorer. I can't put a ton of money in that. So Walter down here says, Kelly tells you the mathematically optimal bet size given the risk reward of a bet. When you bet too big, your returns fall, not risk adjusted returns, actual returns. overbet enough and your returns go negative. But when you underbet, you still get most of the returns. So this is conservative, and this is your return going up. And this is your aggressive insane. So aggressive is kind of you're conservative to slightly aggressive here. That's where your returns maximize. But when you start to go into the insane area, your returns start to go lower. So this is a half Kelly. Betting gives 3/4 the return with much less volatility on a more conservative side. Kelly bets gives the highest return here. And then at twice the Kelly bet, return is 0, your gambling or risk-free rate. So your bet or position size when you're taking on leverage. This is serious overbetting leads to negative returns because you're gambling. Coming on back. Let me go back again. Okay, there we go. So Logan says the supply and demand equilibrium broke in 2020, and we are far from being back to normal in terms of inventory of U.S. total housing inventory. The same premise until we get back to 2019 inventory levels. Too many people are chasing too few of homes. This explains housing even with rates this high. The bad trend is your friend chart. And we are down at very low inventory levels for U.S. total housing inventory. And inventory is rising around us, but the dollar, the money people are asking for justifiably insane money for what it's reached a whole new level of crazy in the past month. And again, you have to remember we've got very low inventory. Now, there are some cities that are getting back to more normal inventory levels, and they will have potential price pressures in those cities. So here's Peter. It says, remember, anyone betting on a soft landing is betting that the unemployment rate will simply move sideways from very low levels. It's never happened before. So this is the unemployment rate is a highly mean reverting series. And you can see that every time it reverts upward, so it reverts going down to up, where unemployment increases, it generally takes off. So we've tightened in the system too much, or there's an underlying problem in the system due to the system going through its cycle where unemployment does go up, and it goes up rapidly, causing a slowdown in the market. So here we are, we've made the turn higher. It's been slowly creeping up, and we'll see if it starts to work its way on up. The Great Marti says Nasdaq Twin Peaks, major warning, lovely double top on the monthly. Divergence on the technical indicators indicating weakness. Hallmarks of a pending biblical sell-off is in his opinion. So again, this is the Nasdaq. He thinks that this is potentially a double top. And you can see some of the indicators here. The RSI is at a very high level. Now, that doesn't really bother me. At least me, myself, I don't really care about the RSI because you can stay at an elevated RSI and not really crash. Even when it comes on down, you can see how the RSI is moving and it didn't crash at all. But relative strength indicator, we are diverging lower with lower highs. We're also doing that on the CCI, composite something index. I can't remember what that is, but it's also heading lower. Is this a double top in the NASDAQ? If I were to make a guess, guys, I think it is. I think it is. I think that we've pushed a lot of money into tech and into the S&P 500. I think interest rates being where they're at is going to cause a slowdown. And it's going to be a slowdown that looks similar to something like this back in the 2000s. In the 2000s, you had an ultimate peak, and then you had a bull trap, and then it went and it sold off. Your bull trap today is basically making a double top. And that's how I view it. Could this bring down commodities? It very well could. Very well could. But there's also another thing here that is key. It also means that we're that early. And if you know this information, if you know where the valuations are at for commodities, and we get a slowdown that does drag down commodities to some degree, well, there's your opportunity to buy more. I mean, a lot more. And you can do it probably at pretty good prices. So this does look a little bit toppy to me. Coming on back, we've got Geiger Capital. He says, Warren Buffett on valuations today. Opinion, it is after that big chart that I just showed. It says, I don't think anyone at this table has any idea of how to use $189 billion in cash, and therefore we don't use it. We only swing at pitches we like. Today, things aren't attractive. We're not using it at 5.4%, but I wouldn't use it at 1% either. But don't tell the Federal Reserve that. I don't mind at all, given current conditions, building our cash position. When I look at the equity markets and the composition of what's going on in the world, we find cash quite attractive, in his opinion. And maybe that's tying to what I just went over here on this double top. Maybe that is what he's seeing. We did see a lot of the tech boys sell out of their stocks. Jeff Bezos, Mark Zuckerberg, Bill Gates, the Waltons, and there's more than that. I'm just naming the ones off the top of my head. So maybe there is something coming. And Buffett's actually a pretty good market timer. He's really good. But he did buy a bunch of oil companies. Just an FYI. Steven says, so far in 2024, the U.S. dollar index DXY is up about 4%. And the U.S. 10-year yield, TNX, has risen about 70 basis points, despite higher rates and a strengthening dollar. The U.S. stock market, SPX, has gained about 8%. What do you think stocks will do if these intermediate headwinds abated? Meaning, what if they go down, the dollar and the 10-year yield? I'm not exactly sure what the total impact will be on stocks if rates were to go down right now. I'm not exactly sure. But if they do go down, it makes me think that we do have an uninversion of the yield curve and a slowdown is possible. That is where my mind is at. Scrolling down to, it says, Warren Buffett is selling off stocks, leaving us wondering what's he planning for all that cash. It says Berkshire Hathaway's cash pile hits a new record as Buffett dumps stocks. Billionaire investor slashes his stake in Apple, which he has described as one of Berkshire's four giants. Yeah, so what the heck is he doing? He's got to be thinking that this chart up here is actually true and we could potentially head lower. We've got an inverted yield curve, and the curve, once it uninverts, that's when you generally have problems in the market. So it seems like all the tech billionaires are getting ready. And I know Warren's not a tech billionaire, but it seems like they're all getting ready for a potential slowdown crash. Here's EEM, which is emerging markets divided by the S&P 500 in a multi-decade symmetry. Significant question mark. And this was 98.99, the commodity bottom for commodity to stock ratio. We're coming on up here, and we had another bottom in the ratio of 2020, but it looks like we didn't get any surge higher in 2020 for emerging markets. Are we at a double bottom here? This is something that you should be watching. Emerging markets is a really good way to play this in a commodity bull market. And I think we are real early. And if we get that tech crash, that's generally where they lower interest rates. We'll probably have the housing market take off. Affordability will be good, or better, I should say. And I think emerging markets is going to rip because the dollar is going to get weak when they lower or cut interest rates. M2 continues growing well above its historical trend. He put a trend line here. Zoom this back in there, guys. He's got a trend line in there, the green trend line, and we are up and above, and the M2 money supply is increasing again here recently. There's the greenage increases on the right. We had reverse repo that was sucking cash back into the markets here in the red. Ray Marti says, Arthur Burns' major policy mistakes in the early 70s that led to stagflation. Jerome Jerome's policy mistakes are not only similar, but far greater. So let's go over these mistakes that Arthur Byrne in the 70s basically had done. It says the stop and go policy, Burns implemented a stop and go policy, raising rates to fight inflation, then lowering them again to stimulate the economy. This created uncertainty and hampered long-term planning for businesses and consumers, misreading public tolerance. Burns believed the public wouldn't tolerate high unemployment needed to control inflation. This may have led him to prioritize short-term economic growth over long-term price stability. And I don't think he did anything wrong. I think he was just in the wrong place at the wrong time. And we had a large demographic coming into home buying years, which is very inflationary. And they also spent a lot of money, not just on homes, but on everything. Having kids, buying stuff for the homes, et cetera, et cetera. Wrong place, wrong time. That's all it was. This is a Kobayashi letter. Again, breaking. Warren Buffett, Berkshire Hathaway cuts its investment in Apple by 13% in quarter one of 2024. This is the second straight quarter that he has reduced his stake in Apple, and he doesn't like to sell stuff very often. He's usually a buy and hold forever type of guy. Alfonso says, is it time for emerging markets to catch up? And we've got copper futures here with a very similar chart as emerging markets. And again, guys, copper's been ripping it, and I think emerging markets is going to follow. A lot of the emerging markets are commodity companies, and I think we could see a big move. And there's a couple of ETFs that I watched that look absolutely fantastic. Absolutely fantastic. I'm going to skip Gary's one. Investment wisdom, it says, Ben Graham taught me 45 years ago that in investing, it is not necessary to do extraordinary things to get extraordinary results, says Warren Buffett. Charlie says, people underrate the importance of a few simple big ideas. Tusa Research, it says, without these metals, there's no green revolution. Lithium, nickel, cobalt, manganese, and graphite are on the U.S. Department of Energy's ARM list. We also got our boy Platy up here. Platinum's in the red. It is a critical metal for the importance to energy and the supply risk. Lithium and nickel are in the top quadrant. And then cobalt, graphite, gallium, platinum, magnesium, silicon carbide, dysprosium, iridium, neodymium, praseodymium, and terbium, some rare earth metals in here, are all critical to the medium-term importance to energy and supply risk. Francis says, time will tell where the unemployment rate tops out for this cycle, but odds are that this will not happen for a while, in his opinion here. It generally takes about 2 years for a change in the Fed funds rate to be reflected in employment. It seems clear that the story is just beginning. So he's saying that we've got some time before this potential peak occurs. And that is where I'm uneasy a little bit because I'm looking at the Nasdaq going, that doesn't look too good over there. But we'll see. That's where I'm going to be. And a lot of the times you see a big spike in oil before a recession. That occurred a few times. So we haven't seen that spike in oil yet. And that's generally what can kick things off on the unemployment side and also in the tightening side for the interest rates. And then everything over tightens and then boom, it all falls apart. So in his opinion, it's going to take some time here for unemployment to basically kick on up. Warren and I do more reading and thinking and less doing than most people in business. That's what created one of the most successful business records in history. Warren has a lot of time to think, says Charlie Munger. And that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. If you want, subscribe to the website as well. We've got a Sunday question and answer session, which is today, 5 p.m. Mountain Standard Time. So if you want to join or if you want to get on to that Zoom meeting that we've got, jump on, ask me whatever questions you got, and I'll give you my opinions. All right, guys, we'll catch you later. This is Finding Value.